Hello, welcome to the Paper Podcast. I'm Ryan James. Hope you like everything that you're hearing from me. Please hit the like button, subscribe, comments. I'd love to hear from you. And just a couple thoughts. Today's April 19th, and last week I was at a capital markets cannabis conference, Bazinga that was put on. It's a very big conference in regards to funding and legislation and a lot of different things, and all things being cannabis and licenses. And so it's a good product. And some of the things that I kind of noticed, there was some newer banks around, which is great. More banks that are involved in the, because the genie's out of the bottle. There's more states than not that have it, either medical or recreational. And let's face it, the industry needs to be banked, and it needs to be banked properly. But with anything that I kind of noticed, and that you got to be fearful, if you're not banking cannabis, like any new product, you've got to go through your risk assessment. You've got to get a new product, go through your board, follow all of the traditional steps like for any new product. One thing that I was kind of seeing some of the banks, and there's a lot of fear, from banks now that are, oh my goodness, I have lost deposits this quarter, and so now I need to get new deposits, and so they're going into a new industry that they don't necessarily know anything about, so, and if you're a cannabis operator, you need to kind of watch out for banks that are jumping in an industry real quick because they're fearful for losing revenue in other areas of their bank. So now they're wanting to get in and get deposits over on this side. You definitely want to make sure, the bank's already coming from a position of strength and not, trying to get a new product to save themselves with anything. I'll always kind of look at that. But then I'm also seeing too, on the lending side, bankers are doing the same thing, and you really got to know your product and know, learn from mistakes and go back to your first source of repayment, your secondary source of repayment. And of course, bankers, if you're financing a location, the tenant may be, let's say you're board approved, everything's gone through, and you want to finance a location, and the tenant 100% occupied is leased to a legal licensed cannabis operator. Typically, they're paying higher than market rents. And so what I'm seeing out there are, if they're paying 60 foot, but in that general area, another tenant's only paying 30, 45 a foot, and you have an appraisal done, the income approach is going to be much higher with that lease in place because they're paying well above market rate. And so, going to be excited. Okay. What traditionally is $1 million property, for argument's sake, that for everybody else is going to be paying 30 a foot to, let's say Chipotle would be in that area, is only paying 30 a foot. But yes, you got a cannabis operator that's paying $45, $50 a foot to be in that area. Okay, well, the appraisal and the income approach is going to be significantly higher. So, your policies are probably going to end up being anywhere from 70% up to 85% owner occupied. If it's not owner occupied, it'll be 70%. But if you're doing 70% on that higher income value, so a lot of things can change. Just because everything is profitable now doesn't mean it's going to be profitable there. Not every location, you still got an emerging industry. Not every location is absolutely going to be a winner. Not every organization is going to come in, and we're starting to see businesses that have flooded the cannabis industry with hundreds of millions of dollars and them not get a return and aren't doing well, that they just didn't operate. And, there has been some already that have been able to default on leases. So, what happens if that location is not great for the use of cannabis sales and you have to take back that property? Well, if you loan 70% on that inflated market rent and you think you're going to be fine on collateral liquidation, then, you're completely wrong. You need to look at it and not go to that extent. So, I'm seeing the adages of banks going in, we want to loan 70, 80% on that higher because that tenant is paying $45 as opposed to the average is 30, so you've got to be a banker and take the conservative approach. And if you're looking for that secondary source of repayment, well, if it gets to that point of secondary source of repayment, then clearly that property was not worth that higher market rent because it didn't make it. So when you get it back, it's going to come back to that $30 level. So use your common sense. That may be there. Now, it doesn't matter if your owner wants to pay that above because they're willing to take that risk and they're happy to get into 45 and they're paying for the income approach. That doesn't mean you got to finance that amount. So, take a look at the property, look at the average square foot. You're going to a new area of lending, take it slow, use your common sense, just because, we've got a year of 2023 in banking uncertainty. Don't get yourself in additional trouble because you're not being prudent and you're going against your, traditional conservative values. Yeah. And in bankers, if you're looking on the lending side again, not only you got to look at market rent outside of the industry, you've got to look at the placement, know the state laws. And also you really got to know the bordering state laws. Because if you're, have a potential client that you're in let's say a recreational state, so adult use recreational. So that means any adult from any other state can purchase from that location. So if that location is bordering and close to another state that is, maybe it's only medical, or maybe it's not medical yet, it's going to be on the ballot again. You got to understand that, those sales aren't going to last forever if you're on that state. So you really got to know the market, know the area, and investigate everything. Treat it like any other industry. Just because something is newer and doing well now, you've got to, don't rest on your laurels. Go back. You look at primary source of repayment, secondary source of payment, look at guarantor support, go through each one of the sections. Don't get excited because now I'm just going to get into cannabis lending and what could go wrong? Well, not everyone is going to be a winner, and some locations could be very great right now in sales, and, management could change, and other states next to them are going to change their laws. If you're next to a medical and you're recreational and the state next to you go recreational, well, sales on your customers in that state could go down. And, over time, you've got to build that in and be conservative on your lending, on your exposure into that area. Take all of that in consideration. You need to shock the deposits. You need to do, the analysis like you'd be doing on your asset lending and your ALM. You need to take that and do the same process on all your sectors. And I'm not just saying cannabis. You should really shock that. If anything, that Silicon Valley Bank, taught us is you need to look at your deposits and shock them just the same as you do rate shocks on your loans going up. And of course, shock on your unrealized loss in your bond portfolio. That's what I got to say today. You guys have any questions? If you have any concerns, feel free, reach out. My email, my phone number is very easily accessible. So if you have any questions, feel free to reach out anytime.